9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Yvonne Man with David Ingles.
Good morning. We are counting down to the open of markets in Greater China. Our top stories today, stocks across the region on your screens advancing. We're now second day running here. Optimism that the U.S. lawmakers are inching closer to a deal to end the government shutdown.
Chinese consumers in focus as online and brick and mortar retailers hope for a surge in spending during the Singles Day shopping festival.
And we have a strong lineup of guests talking markets across shows today. JPMorgan Asset Management discusses long-term strategy across multiple asset classes, and CICC will be joining us to talk us to the next step for China's bull market. Welcome to the program. Thanks for joining us today. Lots to get through. It's a rally of sorts and of, I think, different magnitude when you look across the spectrum. All that being said, is risk assets did catch a bit overnight. U.S. futures are somewhat still on the upside. We're looking at gold, for example, which really gave us something to talk about. We'll talk more about this in a moment. But coming up on your screen, some of the proxies in Australia, for example, as we look at this one, for example, 3.3% to the upside. Dollar yen has bumped its head, that's past tense, at around this level in the last couple of sessions or so. So whether or not we'll see whether or not we do break this 154.35 handle here on dollar yen. Very quickly, let's have a look at TSMC. Coming online, Taiwan is up 1%, 1.2 now. TSMC, the next three coming up on your screens are the three biggest suppliers of TSMC in terms of their sort of reliance, percentage of revenue. Slightly mixed picture there. The headline is softer sales, although it did come in still stronger, 16+%, still on track to boost the quarterly sales numbers coming through. We're looking at the Golden Dragon Index overnight. You had a big bounce there, KWEB. Xpeng is going to be interesting. The 16% move has now put it at about a 10% premium over the 8 shares trading right now. And Baidu's up 5% overnight. Something to watch, of course, going into today. Okay, futures. The approach to the open 18 minutes away. We're looking at a flat start. Worth mentioning, we'll get to this later on, HIBOR is actually a bit in a downtrend of late, so 2-month lows in that. Apart from that, Singles Day and everything else in between. But yes, jam-packed day.
Yeah, it's interesting there is risk on, but it's not quite full-on risk on, right? Take a look at the flattening of the yield curve, some say. That doesn't really pertain to maybe it's full-on kind of risk right now and piling into sort of some of the big kind of darling trades once again. So that's one thing. The dollar also kind of weakened on the back of it. So it's not like everyone's kind of piling and saying, yes, time to buy, because there's still a lot of things that we got to get through when it comes to what's happening in Congress, right?
Yeah, there's this ongoing vote. I still can't even wrap my head around the different steps that are taking place right now and where we need to be, for example, to see the end of the shutdown. Not to mention, if you ask anyone around the Fed, you'll get 3 different opinions, right? It's a hold, it's a cut of sorts, it's a cut of 50.
Myron still wants 50, though, right, for December. But yeah, at least maybe now that we know that there might be an end in sight in this U.S. government shutdown, does the sort of fog around the Fed's rate cut path, does that get a little bit clearer now? We'll see.
Yeah, well, we'll see. We'll see if we get the inflation print first and foremost on Thursday. Right, but yeah, let's try and figure out what's going on right now. Live pictures out of D.C. and the latest efforts here to end the shutdown.
Yeah, let's get to the latest there, of course, and it's getting into the wee hours of the night, certainly here. The deliberations of that vote later on today on that funding bill to end the shutdown. Let's get to our managing editor, Jill Deeses. She's with us right now. Tell us what's happening now.
So right now, Yvonne, we're going through about 8 procedural votes in the Senate before they're ultimately expected to pass this bill tonight, so that would end the shutdown. Right now we're on Senate time, so in terms of how long that actually takes, we'll have to see. And remember, we're still kind of at the stage now where any one senator can really kind of delay things a bit further just by introducing other procedural steps. Not stop a vote entirely, but certainly delay it potentially. So in terms of how long it actually takes to get through that process tonight, I think that's still unclear. But, you know, we saw that procedural test vote Sunday evening in the U.S. That indicated that they did have enough votes, 60-40. They convinced enough moderate Senate Democrats Democrats to come to their side, the Republicans, and ultimately vote for this thing. Once that happens, though, once they actually get through the remainder of these votes, remember, it still has to go to the House. If it clears the Senate, the House gets 36 hours notice to reassemble in Washington. Remember, I mean, they've been out for, 41 days at this point? Yeah. So, they all have to go back to Washington, then take a vote. It's not entirely clear whether it actually runs into any obstacles in the House. You've got, obviously, a lot of Democrats that are unhappy, with this bill, but there also may be some Republicans either on either side who maybe aren't happy that it goes far enough to extend the entire government for a year, or maybe there's some other provisions that they're unhappy with. So once it gets to that stage, we'll see where it goes. But yes, again, still has to pass both chambers at this point.
Okay, what's the earliest the government could end the shutdown if things go perfectly to plan?
If things go perfectly to plan, I'd say probably Thursday at this point, because, again, you've got to factor in the fact that they've got to pass it tonight in the Senate. That 36-hour notice period comes in. So I would say you're looking at potentially Thursday at the earliest, assuming all pretty much goes to plan.
Jill, fantastic. Thank you so much. Jill Deese is there, our managing editor, just getting us literally up to speed what's happening here over in Washington, D.C. Amidst this resurgence in two things, right? So the big story across markets is gold coming back, number one, and risk assets, to some extent, of course, AI. That AI trade overnight with the SOX index rallying quite a bit. Asia is following through 0.5% in the early goings this Tuesday. Joining us here in set, Leon Goldfeld, Asia-Pacific head of multi-asset solutions at JPMorgan Asset Management. Joining us now, they put out the 30th edition, of course, of the long-term capital market assumptions. We'll get to that later. But I want to get your thoughts. The short-term markets don't seem to be too perturbed by what's going on in Washington.
I think the markets have always kind of made an assumption that there will be a deal. How long it takes was always a toss-up, but it looks like we are on the cusp of getting that deal. I think the markets are comfortable with it, but the markets always had a view, I think, that we were going to get a deal.
Right.
If we get this slew of data that's been so delayed, what are we going to be watching out for the most in the next few weeks and months?
I think it's still the fundamentals, which is really what's happening in the labour market. Is employment actually likely to fall in one of these monthly readings? There was expectations of that potentially for September. Looking at the ADP data that suggests September could have been very weak, but October a little bit better. I think for the Fed to cut, they need to see some weaker data here. And so the market, I think, is very focused on that. And then, obviously, to what extent does core inflation continue to creep up as the tariffs come through into pricings?
So we're entering, let's call it, the last 6 weeks of 2025. What are your team's suggestions and recommendations now across assets, looking as we wrap up really what's been a terrific year for risk assets?
It's been a fantastic year, despite some incredible volatility in
between. If you watched TV, you would have thought the world was ending.
It did at one point, but then it revived itself. Look, I think 6 weeks is a very short period of time, so to some extent we need to look well beyond that.
Sure.
I think the markets right now are going through a bit of a consolidation phase, precisely to your point, Dave, that we've had this great rally. The markets are needing to digest that. But I think our view is that the fundamentals as we look into 2026 remain relatively good. When we look at growth in particular, macro growth, economic growth, we actually think this soft patch of weaker employment is going to pass. And I think the economy digests the higher tariffs. One of the challenges with tariffs has been is that tariffs have come in, prices have risen, but wages, usually get reset once a year for most people. It's different times for different people. So the tariffs have come in, they've actually hurt real wages, and we've seen US households, particularly the lower end, weaker households, struggling, and that's what we're seeing now in autos.
Right.
But we think as we go into 2026, on the one hand, the tariffs are set. Okay, we still have the issue of the Supreme Court.
That's right.
But in one way or another, the tariffs are probably going to stay. But wages will start to go up again next year. And so real incomes start to revive. And we think growth with that starts to pick up. So the fundamentals in terms of growth is good. The Fed debate 2 cuts, 3 cuts, but at least we think at least 2 cuts. So you've got lower interest rates, you've still got decent growth, and corporates are outperforming the economy massively. We think that continues. It's a tech thing. So we have that. That is what we think is going to drive markets. Against that is the fact that a lot of it is in the price and valuations are high. And so there's this battle between great fundamentals, very difficult valuations.
Yeah.
And the way we try to reconcile that is we lean into the fundamentals, but not all the way. The valuations just
need to compress somewhat.
Exactly. Affect how much magnitude we want to take.
Leon, we'll have more from Leon Goldfeld there, Asia Pacific head of multi-asset solutions at JPMorgan Asset Management. We're staying with us to talk about, of course, that long-term capital markets assumptions there for this year. You see, there you go. We broke it down, right? And we got to ask him, what's a 60-40 plus portfolio?
Yes. Yeah.
It only
adds
get the
up to
math.
100, right?
Yeah. But there you go. PE certainly is a standout there. We'll ask more from Leon coming up. Counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. This is The China Show.
Welcome back. You're watching The China Show, counting down to the open of trade here, just under 18 minutes away. On your screens is the refreshed version of the JPMorgan Asset Management's long-term capital market assumptions. These are the projected returns, 10 to 15 years, annualized, of course. A lot of numbers on your screens. Let's start with the big picture and the key message, and then we'll get granular. Joining us here on sets, Leon Goldfeld, Asia Pacific head of multi-asset solutions at JPMorgan Asset Management, still with us here on set. So I guess before we get into the numbers, what's changed between last year's version and the key message for this year's version looking ahead?
I think actually the broad message hasn't changed that much, largely because in our core numbers, like the 60-40 portfolio, 60% global equities, 40% global bonds, has remained roughly unchanged at around 6.5%, 6.4%. The key thing to put that number into context is that if we take, let's say, US inflation as a kind of a proxy for global inflation, it's not too different, in fact, a little bit higher. US inflation, we think, over the long term is going to be around sort of 2.5%. So you're talking about a 400 basis point premium. So that's a pretty good real return. And then if we look at cash, we think US cash on average over the next 10 to 15 years is going to be 3.1. So again, compared to a 60-40, that's 350 basis point premium. So the key message we have is that staying invested in a good diversified portfolio is still very much the right thing to do.
And diversifying, is it away from the U.S. into maybe this part of the world still?
It's broad. Yeah. Diversifying is probably across asset classes, public and private, but it's also geographic. And in fact, one of the views that we've held for a while, and in last year, or this year rather, it's come to fruition, and we think it will continue to do so, is that the dollar has declined. The dollar, we think, has been fundamentally structurally expensive, and US tends to have a higher inflation than certainly other parts of the developed world, which tends to bring the currency down. So having exposure outside of the US, you do have the benefit of diversifying, having stronger currency as well as other markets.
What's the latest on the tech AI overlay and the concentration risk? And does that dissipate across some markets? Because it's really concentrated quite literally going into this fresh new year.
So when we looked historically at markets and concentration risk, obviously within the US, the current concentration of tech and AI, Mag 7, is maybe unprecedented. But when we looked at concentration as a factor historically in markets like Switzerland, Taiwan, there isn't really a relationship between concentration risk and future market performance. Ultimately, what it's all about, and it's always been about, is the valuation of those stocks. Are they unreasonable? Are the expectations that are built in realizable? We actually think that the tech part of the market will continue to provide very strong growth. And we do think AI, in our macro assumptions, is going to boost productivity. And likewise, we think tech can maintain pretty decent margins. So we're not as worried about the concentration risk as maybe others.
How do I look at correlations for next year? Because this year it's just been like, I can buy a growth stock, I can buy a bond, I can buy gold, and they could all be rallying at the same time.
Yes.
For different reasons.
For different reasons.
Yeah.
Is that going to be the same thing next year too?
I think we've been in a market environment this year, maybe last year, and potentially next year as well, where I think that a lot of the marginal price setting is actually done by the retail investor. And the retail investors tend to chase themes and they chase momentum. Now, it's very hard to predict when the retail investor may step back. I think if you look at institutional investors, they've been perhaps a little bit more conservative on markets than the retail investor. So if the retail investor continues to drive and dominate at the margin, they don't represent the majority of the transactions, but they tend to coalesce into the same kind of group of themes. that it's quite possible that we get this momentum correlation across unusual asset classes continuing.
Okay. Can I ask if you could elaborate further on the role of alternatives in being able to boost returns, and what does it do for duration, for example, in one's portfolio? Because people are trying to grapple with the 60-40 conversation now too.
Sure. I think for investors, particularly now, not institutional investors have been able to access alternatives for a long time, but we're now seeing the so-called democratization of alternatives, and we're seeing offerings coming into opportunity set for retail investors, be it in more liquid, like infrastructure type investment, or be it in private credit and potentially in private equity as well, as you can continue to invest in secondaries which are more liquid. We do think alternatives are a critical addition to the opportunity set for all investors. In our assumptions going forward, the 10 to 15 years, if we just look at public markets, so global equity, global bond together, we think that can generate a pretty attractive 6.4% return. However, if we add alternatives, let's say 20, 30% to that by reducing somewhat the public asset mix, we could boost the 6.4 towards 6.9. So there is definitely additional returns to be had, and arguably for less risk because alternatives diversify. In terms of the duration of the portfolio, it will change somewhat, largely because if we introduce private credit, it's a floating rate asset, whereas if you like, global bonds are, have a duration of 6 to 7 years. This has a much shorter duration, so duration will change somewhat, but you can work around that.
So that is the 40 plus that you're talking about.
That is the 40 plus,
okay.
Exactly. So what we call the 60-40 plus is really 40% in public equities, 30% still in public bonds, but now 30% in a diversified mix of alternatives as well.
It seems like this is a 30th version, so it's almost a rolling revisiting of the key market, longer-term market themes. Can I just ask you, not so much where you guys could be wrong. That's, I think, phrasing the question non-accurately. But what are the assumptions, or which specific assumption are you attaching the least probability to, at least a degree of confidence to?
I think we can actually be wrong on both the upside and the downside. And I think if we pick the most prevalent reason for the upside and the downside, on the upside where we can be wrong is we are still relatively conservative in our assumptions about what AI can bring to the table in terms of productivity. We've been adding to our productivity assumptions, but we've only added, say, compared to a couple of years ago, 20 to 30 basis points in terms of economic growth assumptions. And we've added maybe 100 basis points of corporate margin. So it's not been a big number, and so that number can expand on the upside. On the downside, we've also made an assumption that valuations, while today's valuations are too high relative to history and relative to what we think will be valuations on a longer-term basis, we have assumed that actually the amount of derating isn't going to be that great. So we could be wrong and the derating normalizes more.
All right. We'll be back in a couple of minutes for some final thoughts with Leon Goldfeld there out of JPMorgan Asset Management. He'll be staying with us for a couple of more minutes here. As we count down to the open of trade, just under 10 seconds away until we get the pre-market pricing, we're looking at one stock specifically with a 10% premium overnight, over 8 shares, 16% rally overnight in ADRs. Xpeng is one to watch. Under 10 minutes away, we're looking at $92. That should be updating anytime now. There we go. Oh, there we go. We are up 9.5% in Xpeng in the early goings. Plenty more ahead. This is The China Show.
All right, we've got about less than 8 minutes before the open. Let's get some final thoughts from Leon Goldfeld there, Asia Pacific Head of Multi-Asset Solutions at JPMorgan Asset Management. We didn't really talk too much about China, but this is a market that's likely going to outperform the S&P this year. Are the stars finally aligning, you think, for this market?
I think there is definitely a catch-up going on in terms of how China's performed, both onshore and offshore. And I think the technology narrative that's really been driving global markets has finally arrived in a more convincing way in China. So we do think that is an opportunity, and it's an opportunity that will continue to help the markets into next year. On the macro side, I think our view is the Chinese economy is stabilizing. It's perhaps not recovering, but it's certainly not shrinking any longer. It's going to take a while for structural issues like real estate to really work off. We do think what they're doing, which is a gradual kind of reform, stabilizing supply, etc., will work, but it will be a slow burn on the macro side. But overall, we really like China because it actually offers a diversified narrative to the global picture. And if the US corrects, it doesn't mean that China will correct as much. So it's a diversifier with its own growth optionality.
Leon, it's fantastic to see you. Thank you so much for the time, and let's do this again, I imagine, this time next year with the 31st edition.
We'd love to see you again next year.
There
Thanks
we go.
for the time.
Fantastic. Have a great rest of your year ahead. Leon Goldfeld, there, Asia Pacific Head of Multi-Asset Solutions at JPMorgan Asset Management. Right, going into the open today, what's just over 5 minutes away, Xpeng is in focus. You had the company's AI day last week. You had that robot that people were up in arms about. They thought there was a person inside the humanoid robot.
Yeah.
They had to, I believe they had to splice it open to prove that there was no flesh and blood inside.
It was too human-like.
Yes.
They thought it was a human that was walking on the stage. I thought it was fascinating. Yeah. But yes, it's interesting. This has kind of taken some days to really kind of really play through. But I think it was those comments that they mentioned, right? Yeah. The fact that they think their self-driving AI capabilities are actually better than Tesla. That sent the stock flying overnight. There you go. We're seeing that sort of follow through here in the Hong Kong session. Other sort of sectors to watch, of course, we're watching the lithium side of things. There's been some upgrades there from the sell side when it came to JPMorgan. So they've been talking about raising TNG lithium, for example, to neutral with a price target of $50 here right now. We're seeing Gangfang lithium, for example, up some 2%. And we're focusing on some of the auto plays, given just what we saw with those car sales. Yeah, it was interesting, you know, apart from this whole like Xpeng story, Xiaomi has also gotten a new overweight from Piper there, which is initiating a new initiation when it comes to the EV maker side of things.
Yeah, a few names there. They're coming out with some else. So I think more analyst coverage.
Yeah, but then the car sales side was a bit soft, right? Because you're starting to see these subsidies and the effects of that really start to fade as we get closer to the end of the year. So there you go. We'll get a little bit more on what that means. Yeah. For the industry coming up. But yeah, you're watching also regionally how we're doing here right now.
Yeah, I think to the point you were just making earlier on, TSMC did report after the close in Taiwan yesterday, is reacting for the first time here in the Asia Pacific. Korea is catching somewhat of a bid, I think, I'm not sure. 2.2% to the upside. Nikkei's up 0.7%. So it's a decently modest approach going into the open today, just under, 4 minutes away. U.S. futures coming up on your screens very, very shortly. Asia Pacific is there, and also A50 futures. Among the things to watch, of course, it's Singles Day, and the data that comes through, we'll have a conversation around that. We are in the window for credit numbers to come out at any point now. That's point number 2, I think. The King of Spain is actually in China today. Some of the things that you know only if you work in news. There we go. 10-year yield, bottom of your screens. And I believe as far as the weather is concerned, I think we're still under a T1 here.
Yes. They hit Taiwan, this typhoon from the Philippines and the like. So we'll continue to track the weather. But yeah, also talking about the concentration risk around the Chinex, right? We'll talk a little bit about that with Winnie Xu coming up here as we count down to that open, which is coming up next. This is Bloomberg.
Good morning. Welcome back. You're watching the China Show, counting down to the open of, of markets. We are called higher in Hang Seng, slightly flat on A50 futures. We are in the window for some credit numbers could come out today. We'll give it a few more days, of course, for that window. And we're looking also at, HIBOR's back as far as the topic is concerned. We've been somewhat on a downtrend, 2-month lows than that. Apart from that, we're looking at this tech rally, Yvonne, plus, of course, what's happening in the auto space.
Yeah, so we'll see what happens. Right? Xpeng is sort of it's doing its own thing, but we're going to see how this reaction to some of the car sales that we saw there. The data actually still looking pretty soft, right? So, if these subsidies start to fade, what does it mean when it comes to growth in that sector? And certainly Xpeng, they're like, look, we're not just an EV company anymore. I'm talking about humanoid robots. I'm talking about robo-taxis and the like here. And maybe that technology they're saying and claiming is actually better than Tesla. And that was enough to send the stock up less than 13% overnight as well. Incredible. still, this stock, the volatility around it here this morning. But yes, it looks like this rally is underway and really kind of spilling over to Greater China here this morning. So obviously we're watching tech. We're watching very much the starboard, where really we'll focus a little bit more on the concentration risk around there, because it really has come down to maybe just 5 stocks that have really kind of driven a lot of the moves that we've seen on that starboard. And one of them is, hey, CATL, right? That's one of the ones on the leader of the board. We're up 1% here this morning at the get-go as well. Shanghai is still around that 4,020 level here this morning. And we're watching very closely some of the commodities, right? When it comes to iron ore, steel, copper is doing well once again. Gold certainly has been in favor now, once again, now that we talk about, can we start pricing in Fed cuts? Now that maybe this U.S. government shutdown might be coming to an end, right? Possibly as early as Thursday is what we've been projecting if things go as planned, right, in the House. Flip the boards and see how Hong Kong is doing, because obviously there's also the tech sort of story, the Singles Day story there as well. Alibaba, though, interestingly enough, we're down to 1%. We're going to have Catherine Lim from BI to tell us about her projections of what's going to do well during this Singles Day holiday. But you are seeing pretty punchy moves when it comes to Baidu. There you go. We're up 4.7%. Xiaomi, there we're up 0.7%. Piper was one of those firms that recently had a new initiation when it came to the EV sector. Xiaomi was definitely on their radar as well. Tech is up about 0.7% here right now. It's an interesting kind of call from also Marvin Chen from our BI team that talked about this sort of diversification play, which I think JPMorgan's Leon Goldfeld just mentioned, right? The fact that you have this sort of narrative around tech supremacy, self-reliance, that perhaps gives China a little bit more of that insulation away from some of the global volatility that we're seeing around mega cap tech here right now, that perhaps these thematic plays are enough to at least kind of focus on individual sectors. But we have the likes of CICC coming on the next hour talking about, yes, it might be sector by sector. That's why you're going to see a lot of rotation and a lot of volatility as you go quarter by quarter. Flip the boards and watch the movers here this morning, watching Huawei suppliers. So that story from what we saw in the EU, that they're eyeing some sort of Huawei ban when it came to mobile networks of member countries. Some of the suppliers, it's a mixed bag here, not a huge reaction so far. So let's flip the boards and see how Xpeng is doing, right? That's the big one here today. So there you go. AI day was last week. 11% gains for the stock here right now. And really, I think investors are really trying to maybe change the whole kind of vision around this company right now. It's not just an EV play anymore. It's an AI play when it comes to Xpeng. 11% gains here. The rest of the industry is still looking pretty good, right? BYD is slightly up here despite those weaker numbers that we saw in car sales.
Yep, there we go. So Xpeng is dancing to its own tune there, along with its humanoid robot, given the car sales number. Okay, fantastic.
Let me walk back.
Like what did you walk back? Like Michael Jackson.
Form.
So,
no,
you know what?
I wasn't trying Michael Jackson.
Well, it comes to mind, right? So it's been 40 years since Thriller.
Has it been that long?
It's been that long, yeah. It's 1984. And the reason I bring that up, and this just occurred to me right now, and don't ask me how it just occurred to me. So people have been arguing and debating that humanoid robot that Xpeng put out was too human-like. It's exactly the conversation, but the opposite of Michael Jackson 40 years ago when people were going, oh, that's a bit too good to be true. The way he was dancing.
When he did the lean? When he did the lean?
Yes.
I'm trying to lean into camera.
We actually did something. I know, this is okay. You can check out our LinkedIn. We did a bit of a Michael Jackson thing at the Age came in last week.
David's very into that.
Which is, yes.
Let's talk about concentration risk.
Yes, because clearly I lack it. Okay.
It's not a risk for David, but certainly is for markets when it comes to this whole AI play, right? We did speak to Leon Goldfeld from JPMorgan Asset Management earlier on about that concentration risk in AI, and here's what he had to say about it.
We actually think that the tech part of the market will continue to provide very strong growth. And we do think AI, in our macro assumptions, is going to boost productivity. And likewise, we think tech can maintain pretty decent margins. So we're not as worried about the concentration risk as maybe others.
Yeah, fundamentals are good, but still valuations need to be maybe further compressed, was sort of the narrative and what the commentary from Leon was. Speaking of that concentration risk, let's talk about how we're seeing it across the tech sector in China, because that's increasing the potential for volatility and dampening its diversification appeal when it comes to global investors. Let's bring in Winnie Xu, our Asia equities reporter, to explain all this as well. So, the tech concentration is also becoming an issue in China.
Yeah, exactly, Yvonne. I think something very interesting is that usually we would think China is that diversification case, but when you look at this chart, it basically shows you that China is no better than other indexes that have been struggling with the tech concentration risk. And you can see here on the chart, for example, the Chinex index, which is a gauge of these innovative companies in China. The gains in the top 5 companies on the gauge for the past 6 months or a year to date basically accounts for over 50% of the gains for the overall gauge. And that's a similar story when you look at HS Tech, actually top 5 companies, the gains in those companies accounting for about 100% of the overall gains in the index. And we take a look at the next chart to understand why that really is the case. We can look at some of the moves in these top companies. You see, for example, CATL, Zhongjin Inolite, and also Eoptolink. They are these domestic AI plays. And yes, today they are seeing on the board, they are in the green. But also when we talk about the year-to-date gains, it's not just tripling, doubling, tripling, or even 4 times. So see here, look at the year-to-date gains. Basically, the gains are really just very outsized. And for example, these sun-grown power supply is also an additional AI play when it comes to the requirement for the data centers further power demand.
Yeah, so these are 4 of the 5, right, Winnie, that make up the CATL, sorry, the Chinex story specifically. Can I ask my producers to bring the other graphic back? Because, Winnie, I have a question on other Asian markets and how big of a concern this tech concentration issue is with other benchmarks in the region. I think you have the graphic up on your screens. There we go, yeah. Go ahead, Winnie.
Yeah, exactly. So actually, the tech concentration risk has become a bigger issue for the overall region as well. We were talking about, for example, the Taiwanese TAIEX index here as well, top 5 companies, specifically actually TSMC accounting for over 40% of the weighting for TAIEX. And hence, you can see that 80% of the gains for the TAIEX index so far this year has been mainly coming from these top stocks on the index. And also similar story for the Kospi index, which is up some 60%. Lots of concentration when it comes to Samsung and SK Hynix, accounting for about 30% of the weighting for the index. Now, Topics is slightly less just because it's a broader index. But when we spoke to traders last week about how volatile the sessions have been for Asian stocks, they were talking about Nikkei 225, top 5 companies accounting for about 40%. And hence, any big drops in these tech companies are likely going to contribute to quite a big slump in the overall indexes.
Okay, so what's the way to kind of manage that risk now? I mean, in terms of tech exposure, what's the right amount?
Yeah, so we are hearing really investors struggling with or looking for different opportunities and different strategies. So, for example, when it comes to China, they were talking about these extended AI plays. So just now we were talking about sun-grown, for example. So looking into, for example, power stocks, which have rallied about 40% the gauge last week, I believe. And also we were also looking at some of the chemical names, the aluminum and also lithium, for example. So looking for these pockets of opportunities. And for these fund managers looking at Asia ex-Japan and who are benchmarking MSCI Asia ex-Japan, which has TSMC over 10% of the weighting, they were talking about looking around the supply chain of TSMC and looking at other similar AI names in Taiwan.
Winnie, thank you so much. Winnie Su, our Asia Equities reporter. I mean, just speaking of the tech story, we are on the tail end. Let me just get back into focus here. There we go. Yes. So my left ear is slightly bigger than my right, which means I'm slightly tilted on left side.
Not that asymmetric.
Quite naturally. So we'll see in which direction earnings will tilt. There we go. Tencent comes out in about 2 days or so. The calendar on your screens, and we really have some big names coming up on deck, which really will go a very long way in determining how much valuations can expand even further or compress, and what sort of guidance we'll get, of course, coming out of these companies. So, yeah, companies reporting this week include the likes, and next week, of course, Xiaomi, Baidu, among others. Baba and Meituan have not yet been confirmed as far as the dates are concerned.
All right. Let's get the more analysis now, what to expect from our Bloomberg Intelligence thematic strategist, Shirley Wong. She joins us here now on set. What are you expecting this round?
Yeah, thank you for having me. So basically, as earnings seasons come out, we do expect that there might be bouts of volatility for these Chinese AI stocks in particular, simply because on the back of these massive capex spending news that we've heard about these plans from big tech companies. And so now investors are, looking to see whether or not these Chinese AI stocks can really deliver on that capital spending in terms of profitability and in terms of growth. So last week, the Asian AI names, we did see a pullback in them, and then they recovered a bit, and then they pulled back a bit again. So it's going to be a bit of a flip-flop scenario that we're seeing, and we do expect that bout of volatility to continue into, as earnings come out. And we're also watching for some of these nascent innovation names as well.
Right.
They're still in the early stages of R&D. So as their investors are also looking to see whether or not, they can deliver immediate profitability. So they're might be under pressure as well.
How does the Chinese AI space differ from what we're seeing everywhere else?
Basically, the Chinese AI valuations haven't corrected that much, despite what we saw. Like if you remember Liberation Day back in April of this year, there was a broad sell-off in the market. So they really haven't corrected that much. And in fact, since the trough in April of this year, the valuations on a forward PE basis have actually risen 69% or so. And that's far outpacing the valuations rise that we've seen in the U.S. and in the rest of the Asia in terms of AI space. So we do think that this type of derating in the valuations, re-rating of the valuations is actually a reflection of the extreme optimism that we've seen in the Chinese AI stocks. Certainly China plays a huge part in the global AI race, and they're narrowing that innovation gap with the U.S. So what we're thinking is that some of these extreme optimism can also lend to vulnerability for this set of names.
All right. Shirley, thank you so much. Shirley Wong there, Bloomberg Intelligence thematic strategist there, just laying out, I guess, the big picture ahead of some key earnings coming through out of Chinese tech. And really at the center of that is one company when you think about the global AI trend, TSMC. We'll talk more about that story coming up here on The China Show. Plenty more ahead.
We're checking TSMC shares in Taipei here this morning. We're still up some 1% here, so around 14.90 Taiwan dollars per share after what the chip maker posted slowest growth in 18 months amid an ongoing debate in markets right now over the sustainability of the AI boom. For more, let's bring in Debbie Wu. She joins us now from Taipei. Debbie, so slowest growth in 18 months, but investors are still looking pretty positive around the stock in terms of the reactions so far. What do you make of so far the numbers that we saw?
So TSMC posted its slowest growth in 18 months, but the 16.9% increase in sales in October, it's still better than what average analysts are looking for. So analysts were looking for 16%, and then what TSMC achieved is slightly higher. So that seems to be supporting some investors or industry executives continuing optimism toward the fact that AI demand is going to be strong. Although investors last week showed that they are becoming more jittery as some Wall Street executives warns that valuation for AI stocks is becoming too high. And then Michael Berry's Xiang Management Fund also disclosed a bearish bet against NVIDIA. But still, I think last night in the US, we saw that both TSMC ADR and NVIDIA stocks went up partly because of, I think, optimism around the government shutdown about to come to an end. But still, I think there's still some investors who think that the AI AI demand is still going strong. And then recent comments by industry executives, including Jensen Huang himself, and then Qualcomm CEO also reflected that positivity toward AI growth in the future.
Yeah, I mean, Debbie, the fact that they reported monthly sales of 17%, which, to your point, in context, was actually better than the quarterly projection, yet still, someone still found a way to say this was a slow growth dip. Just help us understand where expectations are right now for a company like TSMC.
I think the expectation. I think analyst investors, they are all trying to figure out whether what big tech in the U.S. they promised hundreds of billions of dollars investments in AI build out, whether that's still sustaining. And then TSMC's sales numbers usually would provide some insight into this. And what's unique about Taiwanese companies is that they are required by local regulations to disclose their monthly sales. So sometimes I think if you tend to read a bit too much into numbers from a single month, sometimes it may affect your views on how the long-term big picture is like. But still, I mean, I think what the numbers that TSMC posted yesterday seems to reaffirm some investors' optimism, as the stock is also up about 1% in Taipei today.
Debbie, thank you so much for the context. Debbie Wu on the latest here in the TSMC monthly sales numbers coming through. Right, just ahead, so I think it's a 16th or 17th version of Singles Day. There we go, 11/11. So we'll have a deeper look at what we've garnered so far and as far as data is concerned, what it means for the companies involved. Plus, of course, we are entering the thick of tech earnings season, so we'll see all of those in context. Plenty more ahead. This is Bloomberg.
Yeah, let's talk about China's Singles Day, right? It's really Singles Month. If you think about it, the shopping festival is now in its 17th year. And it's evolved over the years from just a one-day event to a weeks-long extravaganza. For more on what to expect, let's bring in Bloomberg Intelligence senior analyst Catherine Lim. She joins us now from Singapore. Now, as we start to see Singles Days wind down for some platforms today, Kat, I mean, it still runs through what, until November 14th for the likes of Alibaba and JD. What are the sort of scorecards that investors should focus on this year?
Well, you know, it is the 17th year and we are continuing to see new services being rolled out. And I think this year what stood out really was that, you know, the quick commerce, very fast delivery, you know, you can order not just food, but other items as well. And they're going to get to your house, like, you know, in 30 minutes. And we've seen how Alibaba is also upping their entire user acquisition, particularly for their 88 VIP, which are their paid members. Likewise for JD.com. So, you know, these are some of the numbers that we'll probably be seeing coming through later this week when Alibaba and JD.com closes their campaigns. We're going to see whether, you know, later today, we're going to see things from Douyin or Kuaishou, which will be calling, you know, their campaigns to a close, you know, in 12 hours' time. Yeah.
Catherine, compared to last year, I guess as a proxy for, you know, consumption and consumer sentiment, how did subsidy intensity compare and discount depth as well compared to last year?
Right. I would say that, you know, if I looked at the entire 5-6 weeks of promotions that we have seen, we were off to a very weak start at the beginning of this Singles Day shopping festival. October, many retailers have actually come through and, you know, spoke about how the warmer weather had actually affected sales of certain items, from selected appliances right down to clothing itself. And that's probably one of the reasons why we've also seen some of the platforms stepping up on their, you know, entire subsidies as well as voucher gives away. So I would say that, you know, while, you know, we'll have to actually see what the numbers are as they come through, my take is that, you know, the intensity of these discounts and subsidies definitely are higher than what we have seen last year.
Yeah, what does that mean for margins then, right? For the fourth quarter when it comes to Alibaba, JD, as well as for some of these leading brands in China?
Right. Great question because, as we know on Thursday itself, we're going to get JD.com reporting their third quarter results. Now, obviously, that does not include Singles' Day, but that's going to show the intensity of the competition among the various platforms as they try to roll out new services. Again, as I've mentioned, acquire more users out there. And, in an environment whereby consumption is fairly lackluster itself, the platforms are definitely giving away more profits to try and stimulate the consumption. I do think that is still going to affect their fourth quarter margins, depending on whether you're looking at a year-on-year or a sequential. Keeping my fingers crossed that fourth quarter will be better than third quarter, but we'll see.
Yeah, I still got some stuff in my cart.
Yeah.
Ready to go and deploy.
Hold the trigger.
Yeah. I have until a few more days. Catherine Lim there. Thank you. Bloomberg Intelligence senior analyst joining us out of Singapore. And later on, we're going to hear Stephen Ingle had a great piece on really what to expect from 11/11 as well this year.
Well, not trading at a discount is gold. It's gone the opposite way. So the Singles' Day for gold and AI actually came last week. So in case you missed that pocket of opportunity, maybe you'll wait for the next pullback. Because as things stand, things are doing very well as far as gold and AI is concerned for different reasons. And the equity plays are doing very well, like Laopu Gold, for example.
It was actually interesting in that there's a Bloomberg piece about the inflation numbers that we got over the weekend. And if you take a look at where gold prices are in China, that really kind of masks a lot of the deflation that you're seeing in other sectors as well, and kind of maybe inflated the numbers in some ways. Not inflated, but just at least helped the numbers in some way because gold demand is still so strong there.
Right.
And it's not really just, a hedge on inflation. It's just, there is no inflation, right? So it's very interesting, the gold plays that we're seeing here once again. But once again, we're watching those miners. Laopu Gold, doing very well. Xpeng, there you go. 14% gains right now. This is Bloomberg. All right, welcome back to the China Show. Here's a look at the HSI half hour into the session. And yes, looks like we're punching moderate gains here right now, but we're focusing on the tech space in particular. That rebound certainly is underway and it has really kind of gone global here, given what we saw from the U.S. overnight. So obviously, we talked about the semi-index there. Also, when it comes to this whole U.S. government shutdown, maybe we're seeing near the end, right? The finish line. And maybe that means we'll get a bit more clarity on the Fed. I guess that's the kind of how we kind of how do you say it? This is what the filter through is going to be, and what we're going to look at next.
Yeah, well, if we get the inflation report.
Well, they said so. There seems to be there's a bit of an order. Like people are expecting at least. I mean, they can't release all the data.
Yeah.
So maybe the first thing could be the September jobs report first.
Yes. Okay. Yeah. It might be too late already to expect the Thursday numbers.
But we'll see if it's enough or early enough before that December meeting for the Fed as well.
Well, I mean, one would hope.
I don't know.
We already had a record. So we're currently, I think, in the midst of, I think we have live pictures, which we can show you in a bit, in terms of the voting now. So I think just to summarize and simplify the steps ahead as far as the U.S. shutdown story is concerned, if we do get the progress, ideally, from the voting tonight, it's a 36-hour window for the House to get called back. And then if that goes to plan, then we could see, ideally, if all things go extremely smoothly, that the U.S. government reopens, or the shutdown ends, to be more specific, come Thursday. All that is to say, everything needs to be perfectly planned. All that is also to say that the AI trade has somewhat masked some of the concerns, if at all, when it comes to the shutdown. We can talk about gold because there's a Fed follow through there too. Asia Pacific is doing well. The Kospi is lifting just about most things. We talked about concentration risk. Kospi is today, in fact, just in the Korean chip list coming up on your screens very, very shortly, if not already. So you have like the Samsung coming out. SK Hynix is there as well. Oh, no, we don't have SK Hynix. SK Hynix is actually also doing, I think, quite well. 6% to the upside there. We talked about golds, and I think coming up is spot gold on your screens. 0.5%, and the sort of equity market iterations of that are also coming up and also catching a bid because of this really big and sharp rally we've seen in the last, 24 hours or so as far as gold goes, with the exception of, I guess, one in Japan. But yes, a lot of the ETFs that are traded. I think we have, I'm going to ask my producers to do this a bit later on as well. Some of the ETFs, can we look at that as well in mainland China? Those will tend to also do quite well on a day like today. But anyway, of course, let's talk about the Fed.
Yeah, because I think that is what's the transmission mechanism, I guess, when it comes to gold, right? Is that because there's the end of a government shutdown, perhaps that's lifting the fog around what the Fed's next moves are going to be, right? You know, up until now, given the lack of data, it's been up to a coin toss of what they could do, cut or not cut in December. But I think that's why the lack of data is also leading to a lot of diverse views within the FOMC itself, right? You just heard from Stephen Myron. Of course, he wants a 50 basis points cut still in December. But then we also spoke with the likes of San Francisco Fed President Mary Daly, the St. Louis Fed President as well, who gave us kind of different views on what they think they should do next.
We also see a labor market that's softening and wage growth that is moderating. So you're really not going to see a lot of pressure coming on the cost side of labor. So I put those things together, and we don't want to make the mistake of holding on too long for rates, only to find out we injure the economy.
It's very important that we tread with caution here. I think there is limited room to ease policy further without policy becoming overly accommodative.
Mark Cudmore has graced us with his presence today, our executive editor out of MLab, joining us from Singapore. Mr. Cudmore, thank you so much for making time for the show today. Where is your head at today when you look at markets? Let's start there.
I think the bigger backdrop is we are still entirely dominated by the AI theme. This week we're obviously focused on the shutdown, but this is really kind of a temporary news story that's going to matter for a couple of weeks. Ultimately, where we're going in markets is how strong the AI theme is, and that remains very solid for at least another earnings season or so. I remain in the camp that we're in a bubble in terms of AI capex, but we're not close to the bursting of the bubble, and I think it's probably not going to burst until sometime far into 2026. I'll remain open-minded in that, but that's the backdrop view. So the underlying view is kind of quite bullish and constructive. Going to the shutdown this week, I think if we get resolution, that's a short-term pop in sentiment. It's probably bad for treasuries. It's probably good for dollar at the margin. I think dollar yen's going to continue going higher in this region. So they're kind of the bigger picture views. On a very short-term basis, despite the fact that we're seeing gains across many assets today, and some of the most risky assets are really gaining, the price action at the moment isn't actually overly encouraging, the kind of the narrow breadth, the way we're kind of quite jerky in movements. It feels like the temporary pullback in stocks that started a week ago hasn't fully exhausted yet. And it's kind of quite worrying in a way for the health of this market that we've seen such a bull rally with such minimal pullbacks. It's kind of lulls us into a full sense of complacency. And even though I think we've got higher levels to go overall, I would expect some bigger corrections over the coming months.
Okay, bigger corrections. Maybe just kind of highlight that. How is that going to play out? And what do you think is going to be those triggers to maybe burst that so-called AI bubble?
Yeah, so I do think that the dot-com analogies make a lot of sense here. So if you look between, say, October 1999 and March 2000, I think we had 4 10% plus corrections in the NASDAQ before we actually peaked out. And that's actually while the index doubled in that period. Now, in this modern era, we've got lower volatility in stocks, we've got greater transition of information, so the cycles are probably shorter. But I do think that when we get to the end of the bubble phase, that probably means that we get through a period of where we do see, maybe frequent pullbacks of 5% or more in the last couple of months of the bubble, which is why I don't think we're quite at the end of the bubble yet, or one of the extra reasons why I don't think we're there yet. How do I think this will play out? I think that there's a lot of circularity in the AI theme at the moment, but earnings are strong enough to prop that up. What will happen towards the end of the bubble is that one of these pillars will be taken out. To me, it seems like the earliest we'll see that is probably, the fourth quarter earnings, which we kind of get in January, February time, and that's the very earliest. In reality, I think it's probably more like an April story. That next earnings season is when we'll see the fact that people are still not seeing sufficient revenues to come through to back up the promised spending, and hence the debt behind this kind of AI circularity bubble.
Mark, back to your macro FX hat, if you could, for us. Dollar yen's back above 154. We've tested that level. We've yet to deliberately and really see a clean break of that level. What do you think happens with dollar yen from here?
I think it's going quite a bit higher still. I don't think intervention risk is likely anytime soon. There's a few kind of, back of the envelope rules you look at for dollar yen intervention. One is, do we have a 10 yen move within a month? No. Another one is, have we seen 6% move within a month? No. Are we at levels that are yet scary? No. We are higher only last year. And finally, what's the kind of backdrop here? This isn't a good environment for intervention. So as we, of course, go higher in dollar yen, I expect verbal rhetoric to increase. But I don't think we're going to get actually intervention, real intervention, until above 158 and probably a chunk higher still. And the fundamentals are still very negative for the yen. It's got deeply negative real yields. In a risk-on environment, it's still the most favorable carry trade. Japanese growth outlook is terrible next year, even despite the new fiscal spending. And it's got an overhanging debt problem in a world where fiscal concerns continue to kind of mount at the margin. I know it's a slow-moving structural story, but Japan is at the forefront of that. So the fundamentals of the yen remain deeply negative. We're in a temporary period where dollar strength seems to be en vogue around the shutdown story. I'm not saying dollar is structurally strong, but for the moment, I think dollar yen can go much higher. I expect we'll be up towards 158 in the next couple of weeks, and that's when we might get more nervous about intervention. But in reality, intervention may be above 160 type story.
Mark, great to have you. Mark Cutmar there, our MLab executive editor, joining us out of Singapore. We'll take you now back live to D.C., where we are hearing that the Senate has enough votes to pass the stopgap government funding bill. So this is one step closer to potentially reopening the government there and ending the longest shutdown that we've seen in U.S. history. But yes, we talked about how the procedural sort of things that moves moving forward here, right? So the Senate, now that we've gone through maybe that, the House members now must now travel back to Washington to vote for the first time since September of 19th. So that final sort of Senate vote to pass the spending bill, that's expected today, of course, right? But then it goes to the House for approval. That's going to likely happen on Wednesday. And we have heard from House Speaker Mike Johnson that he's going to give House lawmakers 36 hours notice to return to the Capitol once, of course, the Senate passes that bill.
Yeah, there we go. Next step is an actual vote,
yes,
and then it goes to the House, and it's a step closer to seeing potentially further funding to furlough government workers and maybe fund also some agencies through the end of January of next year. A step closer, not quite all the way. We'll get you more updates once we have more information out of D.C. Coming up here on the China Show, from Sydney to Hong Kong, we'll discuss how to navigate China's challenges and ever-shifting trade ties. Michael Pettis will be joining us in a couple of minutes. Also, CICC's chief strategist, Dr. Miao, is joining us at those times on the screens. This is the China Show. Welcome back. You're watching the China Show. We're about 42 minutes into the cash market session. A look at how some of the Huawei suppliers are doing this morning. Mixed bag there. Bloomberg has learned that the European Commission is exploring ways to force EU member states to phase out Huawei and ZTE from the region's mobile networks. Min Lo is here with the details on what this means and what the concern here is exactly, and how it will actually be enforced if that does become the case.
Yeah, the concern here is about national security, right? And it's been an ongoing concern since 2020 during Trump's first term, when the European Commission had come up with this so-called 5G toolbox. Is a policy recommendation for its member states to exclude what it calls high-risk vendors like ZTE and Huawei from the region's telecommunications network. And since then, there are about 10 out of the 27 member countries that have adopted that toolbox. So the majority haven't, and the European Commission now wants to upgrade the policy policy recommendation to a rule, a law, so that countries that don't comply will have to face some sort of infringement procedure and face financial penalties. Now, obviously, this is something that could spark a lot of political debate in Brussels because a lot of countries are already quite reluctant to surrender their national security decisions to the European Commission. And there are some European telecommunications providers that are opposed to this as well, saying that Huawei is, in fact, a cheaper and better alternative to Western firms.
I mean, this is likely going to escalate tensions with China. How is Beijing likely going to respond?
Well, China has played this game before, right? Because back when the policy recommendation came out, there has been countries like Sweden, one of the earlier ones, to ban Huawei. And at that time, China had pushed back verbally with a lot of threats to Sweden's Ericsson. And eventually, there wasn't a formal ban, but we did see Ericsson's market share in China collapse. It failed to win government bids on contracts from the likes of state-owned companies like China Mobile, for example. And FT recently reported that China already now require companies like Ericsson and Nokia to go through what it calls a black box security review. It's not clear what sort of review these gears will go through when they get to the tech regulator, but it's a process that could take 3 months or more, and that already put these companies at a disadvantage compared to the Chinese peers. So obviously, both sides are looking to decouple and strengthen their self-reliance on the tech frontier.
All right, Min Lo, our China correspondent there on the latest when it comes to EU and China relations and some other big corporate stories that we're tracking for you today. Restaurant Brands International has agreed to sell a majority stake in its China unit of its Burger King chain. And the Burger King owner entered a joint venture with asset manager CPE, who will invest $350 million to boost Burger King locations in China to more than 4,000 by 2035. After completion of the deal, CPE will own about 83% of the business. Hong Kong has sold a new set of digitally native green bonds denominated in 4 currencies. Sources say the equivalent of $1.3 billion of the notes were priced in U.S., Hong Kong dollars, euros, and the offshore yuan. Now, this is the city's 3rd such sale since 2023 and comes as Hong Kong takes steps to encourage tokenized bond issuance.
Right. An update on this rally in shares of Xpeng today. So we rallied, I think, 15 give or take 15% overnight, 15% on the dot as we speak. So this is currently the best day for the stock. Single biggest move here since November of last year. Takes it now to the highest. So we've taken out effectively the 3 peaks of the year at about 100 and change. Now puts the stock price at the highest here in about, let's call it, almost 3.5 years here, since July of 2022.
Yeah, you know, it's just, there's so much, I think, anticipation of what this company can do now that, you know, maybe it's time to reevaluate the valuation of Xpeng, right? This is going beyond just EVs already, right? You're talking about humanoid robots, you're talking about robo-taxis, and it's really kind of rocking the whole traditional growth model for this company. So, of course, the innovation, we haven't seen it quite translate to earnings just yet, but we talked to Brian Gu about it just last week, about the potential. And they're even saying this technology that they're flagging is even more advanced than Tesla, too. I think that's what set the stock flying today.
Transformational, right? And I think, I mean, let's see if we can play that out for a bit of that for our viewers today because of the stock price
robot
today.
kung fu master.
Right.
It just sounds cool enough.
Dancing robot kung fu master, and really how you
human-like form.
Transformational technology. Is this still an EV brand, right? And how they're using the technology across the supply chains. They're vertically integrating, and they've actually developed the technology themselves. Yeah. Right? And that was the question we really asked him. How expensive was it? He said it wasn't easy to do this, and I guess, obviously I'm risking speaking too soon, is the stock now just in the midst of a further re-rating from where we were thinking this was, well, the market thinking was, of course, in the previous range. But yes, we'll see what happens with this. But we are doing very well on shares of Xpeng today.
Yeah, let's move on. Maybe you'll want to buy a humanoid robot on Taobao. We'll see on Singles Day, right? That shopping extravaganza is now in its 17th year. However, shifting consumer behavior has transformed the traditional one-day sales blitz into a weeks-long campaign. Our chief North Asia correspondent, Stephen Ingle, brings us this report.
Influencer peddling is all the rage in China. Online, of course, but now more than ever before, on the actual trade fair floor as well, where rapid-fire hawking of product over multiple mobile phones direct to China's billion-plus consumers has never been this well, in your face.
I don't know how they talk so much. Everything you would possibly need to know about Vietnamese iced tea.
And other products from overseas. Doesn't matter if it's New Zealand milk powder and ice cream or Italian cleaning supplies, complete with a Mandarin-speaking European. They're all competing for Chinese cyber shoppers in a market where around 40% of all retail sales are now done online.
A single day, 11/11 is huge. We have a strong presence on online platform, and we have a strong focus on Gen Z.
I know Singles Day had another few more weeks to go, but so far the result has been very, very encouraging.
Online shopping in China is growing at 3 times the pace of traditional retail, with many brick-and-mortar outlets feeling that pain. CPI did pick up slightly in October, but overall retail spending is expected to have slowed again as households hold on to savings amid economic uncertainty. Add to that our lingering worries importers and exporters here feel about the fragile trade truce with the United States.
High tariffs are hurting everybody, hurting both sides.
One of the things that as businesses we do hope is that there is longer than a 14-month detente, shall we say, but that there is some general baseline of the relationship. These are areas we're going to trade in. These are areas that are no-go. This is kind of a gray area where we'll keep negotiating on, because that would help us all, to your point, really understand what we can move forward. And if I do want to have a 5-year contract with an American supplier, I know no matter what, I'm going to get that product.
I think it's been critically important that we have clarity.
U.S. wine exports to China this year were down 77% in the 7 months through July from a year ago, with Chinese tariffs and taxes combined amounting to about 75% on American wine. And yet Barros is cautiously optimistic for a recovery, as the truce has kept tariffs from escalating further.
It was a very, very positive development that they came up with an actual number that's going to be in place for the next 14 months. Because before that, I think a lot of importers weren't so upset about the tariff. They didn't know what it was going to be. And so now we know what it's going to be, at least through the end of December of 2026. And I'm hoping that that brings some normalcy back into the process.
It's an endurance game shared in some respect by the many influencers in nearby booths. To keep talking and to keep the parties on the other end engaged. Stephen Engel, Bloomberg News, Shanghai.
Right, so welcome back. SoftBank, one stock that we're tracking now, is set to report. We're up a little bit here, 2.5% after the close in Tokyo today. Investors are focused on whether the group's bets on AI are paying off. Let's bring in our Bloomberg Intelligence Asia telco analyst Kirk Boudry here with us to help us discuss here what exactly we're looking at here specifically. What are you keen to see as far as this one is concerned?
I mean, first of all, I mean we have a partial picture already of what they're going to report, because their operating subsidiaries, SoftBank Corp. And Arm, have already reported they had decent, good numbers. We can also track private or public portfolio performance. So when we look at how the stocks that they own that are publicly traded, and they've done quite well. So in the Vision Fund, they're up $3 billion in the quarter.
That's right.
Right? And then they separately, at the parent level, completely different from Vision Fund, have invested in public AI leaders. And this all started this year. And so they own shares in NVIDIA and TSMC and Oracle and Intel. And that was another $3 billion in gains. Right. So we already know this is going to be a pretty good print.
Okay.
What we're looking for beyond that is how their private equity performance came through. And one of the possibilities for this quarter is the Vision funds have been underwater for almost 4 years.
Yeah.
Right. But the cumulative performance could be back to break even if, combined with the public gains that we've seen, you also have an uptick in private valuations.
I mean, everyone's want to track the investment plans of all these companies. When it comes to SoftBank, where does this all stand now in terms of their AI investment plans? I mean, they've already bought ABB Robotics. They were considering potentially of buying Marvel. Where do things stand now?
It's, I mean, the Marvel news was kind of a surprise, right? But it's, you know, what it shows is that they still need to do something in AI chips. So they own ARM, and that's actually a great investment for AI. But it's not NVIDIA, for example, right? So if you look at NVIDIA,
Well, that scene from, when he was with Jensen Huang, it's like previously he had a bigger stake in it.
That's absolutely nuts if you think about it, because if they had a 5% stake now, we wouldn't even be talking. People go, oh, yeah.
We wouldn't be talking about the private equity stake.
No,
right.
Or Marvel, maybe, yeah.
None of that would be relevant. But they do want to do something more in chips.
Okay.
And so something that they combine with ARM and to more directly grab some of those profits on the chip side or on the infrastructure, AI infrastructure side.
All right. Kirk, thank you. It's great to have you. Kirk Boudry there, our Bloomberg Intelligence analyst. Yeah, and the stock itself has been massively, right? It's gone up so much. The market cap is actually now the second largest listed company, right? And it really surpassed the likes of Mitsubishi UFJ. Yeah. We're getting closer to even Toyota. We're talking about for SoftBank's market cap now as well, Dave.
The transformation of the Japanese market, right? The other one is Advantest, which really shows you that the Nikkei is almost like an AI plane, if you think about it. But we'll have a look at this when it reports, of course, later on. Speaking of chip stocks, on your screens doing, I think, quite well and decently today. We will leave you with a look at this. On the other side of this break, we'll have a deeper dive into all things China, all things macro. Michael Pettis joins us. And of course, after that, we're joined by CICC, the chief strategist there, to talk us through really what this bull market holds going into 2026 and how you really lean into the sustainability of this liquidity-driven bull market here in Greater China. Plenty more ahead. This is Bloomberg.
We've got some breaking news when it comes to D.C. So it looks like the Senate has passed that stopgap funding bill and now tees up to that House vote next, right? So it still needs to be passed by the House and signed by President Donald Trump. But of course, the president has endorsed the measure. We also have heard from Speaker Mike Johnson. He thinks it will actually pass quickly as well. So we are one step closer and nearing the end of this U.S. government shutdown, though it really depends on what happens, right? You've seen some backlash within the Democratic Party, the likes of Senator Elizabeth Warren, House Democrat leader Hakeem Jeffries, who say that the party should have stood and fought for health care, right? Because we didn't include that extension, of course, of those Obamacare subsidies. No. So, some have called this a terrible mistake, an empty promise as well. So we'll see how this all fares in the House.
Yes, and the next step here is, of course, I think it's a 36-hour window for the House to gather and really cast their vote, I think, for the first time since mid-September, right? So it's been a few weeks since, of course, we've had that specific activity at that part, of course, of the legislature as well. But as things stand, as mind you, of course, the vote was 60-40. As things stand, we could actually see the U.S. government reopen or to shut down on a path to end as soon as midweek, which might just give us enough time, of course, to get us into more of the more pertinent economic details for the markets to make, to really have a better sense and grasp of what the economic reality is, as we just whipsaw between bets around how big the Fed needs to ease interest rates by. If you go by Stephen Myron, of course, he thinks it's about 50, but if you ask others, of course, they do think, of course, we might need to skip December. Right. Just to recap some of the things that we just mentioned here, the Senate has passed the stopgap funding bill, and this then passes the ball on to the House, which needs to gather in the next day and a half or so and be able to vote through that one. And then we'll see if, of course, we reopen and the shutdown, this record shutdown ends by about midweek. Currently, we're on track, but, of course, lots of risks to watch as we go from here to there.
Yeah, let's bring in Laura Davison. She's our Washington Deputy Bureau Chief. She's been staying up late, of course, as we track these developments. And Laura, this bill goes to the House next. What are the chances this is going to get passed?
Chances are looking pretty good right now. Democrats have said that they're not going to vote for this bill, but Republicans are planning to vote for it. Republicans hold a narrow majority in the chamber, so Mike Johnson, the Speaker, is going to have his work cut out for him, keeping everyone together. But right now, chances are looking good. And one thing that has this bill's wind behind its back, especially for Republicans, is that Trump is coming out and supporting this bill.
Okay, Laura, David here. What are the key risks to watch here? just to help us understand in terms of what gets us from here to ideally Wednesday and, of course, the end of the shutdown?
Yeah, so a couple things. One, so the House will come back, as you mentioned, probably midday Wednesday and vote. The key group to watch is what's known as the House Freedom Caucus. This is a group of about 20 to 30 members who are kind of ultra-conservative and tend to not vote for some of these spending bills. We see in the House a lot that they defect and Republicans have to get Democrats on board. That's going to be pretty tricky in this scenario. You may have, like we saw in the Senate, some moderate Democrats who do want to vote for it. So it's really a numbers game of can they get enough to get a simple majority. That's what they need in the House, is a simple majority to get this bill across the finish line.
Laura, thank you so much for an update there. Laura Davison there, our Deputy Washington Bureau Chief, with the latest here out of Washington, D.C. U.S. futures are flats, so no reaction across markets to this developing story. Plenty more ahead. This is Bloomberg.
Well, the U.S.-China trade truce has taken effect with the latest from the Trump administration delaying an export control rule enacted at the end of September. Now, earlier, China also formalized those rare earth curbs suspension as well. For more on the outlook for U.S.-China relations, Paul Allen is at the UBS Australasia Conference in Sydney with our next guest. Hey, Paul.
Larry.
Thanks, Yvonne. We're joined now by Michael Pettis, Senior Fellow at Carnegie Endowment for International Peace. Michael, thanks so much for joining us today. And I do want to just start with your thoughts around, well, I guess, could we call it a trade détente between the US and China? How do you feel that played out? Do you feel China got everything it wanted, and what did it have to give in return?
No, I don't. I think both sides were really hoping for a little bit of extra time to resolve their own domestic issues. But ultimately, I don't think anything serious has gotten done. So, for example, the U.S. trade deficit continues to grow, and the Chinese trade surplus continues to grow. So we've seen a little bit of shifting around of trade, but ultimately we haven't seen any big shift in the underlying structure of trade.
What happens if the US would actually be able to shrink its trade deficit, if through tariffs or through other means? Could there be some potentially unforeseen outcomes there?
Well, you know, all the talk about trade problems we've been facing is really not true. We haven't faced anything serious yet, because while the tariffs have shifted trade around, they haven't changed any of the underlying imbalances. Now, as long as the U.S. trade deficit continues to grow, it'll continue to accommodate a growing Chinese surplus. If the U.S. were ever able to reduce its trade deficit, which I think it'll figure out how to do eventually, but if it were ever to reduce its trade deficit, that would completely change the dynamics. Because if the U.S. deficit contracts, then either the surpluses of the surplus countries, which basically means China, must contract, which will be very difficult, or the deficits must show up somewhere else, which practically speaking means the European Union, which will be very difficult for the EU.
So linked to that, you have argued previously that this dispute is less about tariffs, it's more about China's savings and investment model and the excesses involved there. So what's the approach for the US if tariffs alone aren't the correct tool to deal with that?
Well, in theory, there are only two things the U.S. can do, right? If you assume that the U.S. imbalances are caused by the excess of saving over investment among its trading partners, who then invest the excess saving in the U.S. economy, then there are only two ways that the U.S. can resolve that. One way is to implement policies that force a change in the saving investment imbalance abroad, which is quite difficult to do. And the other way is to intervene directly and prevent the saving from coming into the U.S. So a much more efficient way of doing it would be to tax capital inflows or somehow to restrict the ability of foreigners to dump excess savings into the U.S. market. The problem is with tariffs is not that tariffs don't work, but under the right set of circumstances, they can have an effect. But that means, among other things, that thinking about bilateral tariffs, implementing bilateral tariffs, is almost a complete waste of time.
Yeah, I'm glad you mentioned bilateral, because we're talking here as if the US and China sort of exist in their own little vacuum, and of course it's not that simple, is it? How do some of the smaller economies, the ASEAN economies, navigate their way through these waters?
Well, they navigate it the way they have been. So, for example, let's assume that as the U.S. deficit continues to expand, one of the forms of that is Americans buy more fish from Peru. So Peruvian farmers now have higher income, and with that higher income, they consume more, a part of which goes into into imports. And through the multiplier, the increase in exports to the U.S. will be matched by an increase in imports, but not necessarily from the U.S. In this case, perhaps they'll buy an electric vehicle from China. So the point is that Peru can only run this growing deficit with China because it's being effectively funded with a growing surplus with the U.S. So ultimately, there isn't really a change. As long as the U.S. deficit continues to grow, it accommodates growth in the Chinese surplus.
Does there need to be a change in China, or can it continue to rely on this current model of exporting and manufacturing to keep on powering its growth?
Yeah, but it's very difficult for China to change. It's so locked into this existing model, and its response for the last 10 to 12 years to every problem has been to double down on the model. So how do you raise domestic consumption? Domestic consumption is not an accident or an oversight. It's fundamental to the way the manufacturing sector works. Chinese manufacturing is incredibly competitive for exactly the same reason that Chinese domestic demand is very weak. So if you want to fix one, you undermine the other.
Well, there's an obvious awareness of this problem within China as well. The fourth plenum passed measures to try and address this consumption issue you're talking about, but was it enough? Do you anticipate more coming?
So far, there's been mostly talk. If you look, for example, last year, consumption performed, for all the talk, consumption performed very weak. What really saved China was the huge increase in the trade surplus, which we're going to see again this year. But it's not clear that we can see this continued growth in the trade surplus. And once that changes, then we're back to the two main drivers of growth, which are too much investment and not enough consumption. And it's very hard, as you know, to raise the consumption share of GDP. Other countries that have had the underconsumption problem have never been able to resolve it except under very difficult circumstances.
You know, it's always very inviting, and I know this is something else you've written about, to think of as China as just a control economy, that the command comes from the top and it happens, but you say it's not that simple. Local government does have a lot of input here as well.
Sure.
Is that part of what's happening here? Is that why it's difficult to get a consumption policy that sticks?
Well, what happened is that China needed very high investment in the 1980s. It was probably the most underinvested economy in the world for its level of development. And so it put into place a very powerful growth model that had the highest growth rate of investment in history, funded by the highest growth rate of domestic saving in history. But the way you increase domestic saving is by redistributing income away from those sectors that consume, which are basically the household sector. So the problem in China is that model was very, very successful, but it stopped being successful once China needed to bring investment rates down, probably 10 or 15 years ago. The problem is that with most growth consisting of consumption growth and investment growth, if you can't get consumption growth to pick up pace, you can't allow investment growth to decline unless you're willing to accept much slower GDP growth. And China's locked itself into this GDP growth target from which it's finding it very difficult to back away.
All right, Michael, thanks as always for your insights. That is Michael Pettis of the Carnegie Endowment for International Peace. David.
Thank you very much.
Paul, fantastic. Paul Allen there in Sydney for us. In fact, coming up, we're really just extending the conversation Paul just had there with Michael Pettis, and really G2, China-US, coming out of the meeting in Korea, what this means for the bull market in China. So CICC's chief strategist joins us. Their latest report, the next step for China's bull markets. We'll unpack that story next. This is The China Show.
I think there is definitely a catch-up going on in terms of how China's performed, both onshore and offshore. And I think the technology narrative that's really been driving global markets has finally arrived in a more convincing way in China. So we do think that is an opportunity, and it's an opportunity that will continue to help the markets into next year. On the macro side, I think our view is the Chinese economy is stabilizing. It's perhaps not recovering, but it's certainly not shrinking any longer.
Yeah, that was JPMorgan Asset Management joining us on shows earlier on, outlining, I guess, the really dramatic change in views and attitudes towards this Chinese market, really compared from about 3 years ago. So the latest here is where do we go next with this bull market, right? CICC has published, it's in my hands right now, has published the 2026 H-Shares Outlook report. They project abundant liquidity will continue. That has been, of course, the secret sauce underneath this bull market. What happens next? Credit cycle will move towards volatility, even a downswing. They also see limited upside potential on an index basis, but opportunities within, of course, sectors and rotations in and out between really a lot of the alpha trades there in the H-share market. Joining us for more on this, the author of that report, the chief strategist at CICC, Dr. Miao Yanliang. Good morning and very nice to see you, Doctor.
Good morning. Very glad to be here.
So, what's the next step? The title of the report, the next step for China's bull markets. Where do I look for the next step?
Yeah, I think, for next year, we still remain bullish. To me, I think the big change is really the global monetary order reconstruction from a strong dollar to a weak dollar, and then from China-U.S. constantly in the trade negotiations to a G2 framework. And then probably more importantly is the DeepSeek moment, not just in AI, but many other industries, whether it's manufacturing or it's cultural or it's biopharmaceuticals. Almost every industry have received their own DeepSeek moment. That, I think, together is the fundamental for a bull market, slow but a bull market. Maybe for the first time in a long time, we'll finally have a slow-moving bull market.
Dave mentioned, right, the secret sauce has been liquidity that's been driving a lot of this rally.
Yes.
Do you see anything in the horizon that could disturb or disrupt this sort of liquidity?
Well, in general, if we talk about liquidity, it's central bank believed to be, they control the liquidity. I think, probably from the U.S. perspective, the Fed is probably, they may pause, but still, in general, is going to be eased further. And then China, of course, I think the central bank monetary policy will remain supportive. That we talk about, dynamic shift of, central banking policy. In addition to that, I think probably more importantly, for a given liquidity, where is the money shifting around within the system?
Right.
For that, I think, clearly to me, money is going to shift more towards Asia, towards Hong Kong, towards China. So I'll give you a number. Of global actively managed money, 56%, that's from the EPFR, 56% is in US asset, 3% is in German asset, only 1.8% in Chinese asset. So that shows too much concentration in dollar asset. To me, that, that's what I meant by global monetary order reconstruction. We need more diversification from U.S. asset towards other currency, and Hong Kong and China are going to benefit from that.
Let's talk about the specific opportunities that active manager subset can look at in the market. So I think this year we've seen almost cycles and rotations between winners. We've seen tech and AI. That's gone into financials and dividend plays. It's gone back out into tech. We've had a materials... New consumptions like Laopu Gold, Pop Mart. And then it's gone back into materials and rare earths, and now tech is back. So do we continue this sort of pattern of big winners, big losers within the market and the opportunities there? And where do you see the next one?
I think, we do see, the shifting pattern. Some sectors rise, and then other sectors, if they haven't risen enough, they're going to rise again. But to me, I think, this maybe, if you have a sustainable, slow-moving bull market, that means probably you will see those who hasn't risen enough, they are catch up. They were going to catch up in this year. So there are a few sectors I still remain very positive, even in terms of AI. I think China and the US both doubling down on this AI race. So I still very positive on that. And then that's maybe more on the offensive side. On the defensive side, I think on the high dividend space and the traditional manufacturing space, the anti-involution campaign is taking effect. That's also going to boost earnings, boost price. That's also going to help corporate bottom line. So I think probably 2026 the market is going to be more balanced.
Yeah. You mentioned in your report about scarce assets. Can you kind of define what that is? And how do you determine what's scarce, depending on where we are in the credit cycle and where are we right now?
Oh, scarce asset. This thing can shift very quickly. It also depends on international sentiment.
Yeah.
This is for example, if something happens, say in Nvidia, in the AI space, and then this is the China and US market move, very in lockstep with each other.
Yeah.
But I say, the scarce, you have to be careful. It's scarce in a point of time. It doesn't mean it's really, if you really believe in the AI story, AI narrative, it may look abundant at a point of time, but in the longer run, it still looks scarce. It's still, very much in the making, if you believe in the long run story of the narrative.
Right.
Yeah.
The common pushback we get when we talk a lot to international investors, that active cohort that still is overweight U.S., they point to still the lack of momentum in the recovery of the economy and the lack of inflation.
Yes.
What are your comments on that, and what's the pushback against that? What's the case for the market to broaden out? Is the rally to broaden out? Is my question amidst that reality?
Good question. Yeah, I think well, we are not out of the woods yet. Inflation this year is around 0 CPI inflation. PPI is negative around 2%. But I do believe the biggest negative shock is behind us. So probably for next year, we are looking at a CPI slightly above 0, or like around 0.5%. And the PPI also improving a little bit. Why I'm saying that, I think it's both supply and demand. On demand, the drag, the negative drag from real estate cycle is getting smaller and smaller. And then I also expect central government to do more fiscal stimulus. And then on supply side, we mentioned the anti-involution campaign. I think that that's very important. But probably more importantly, for the broader economic recovery or the strength of the broader economy, it's really we need to do more structural reforms. Because we talk about consumption. Consumption is a function of jobs, is a function of income expectations. And income is a function of jobs.
Right.
And not only that, I think it's also about social safety net. So in those areas, I do believe China still have a lot of low-hanging fruit. For example, our social safety net for people who retire in the rural area is only 220 renminbi per month, the basic pension. So that has huge room to improve. So these are the areas with low-hanging fruit. I think it's going to be a strong foundation for a sustained recovery and then sustained bull market in China.
All right. Dr. Miao, thank you. Yanliang Miao there, Chief Strategist at CICC, about the next step for this bull market and where we're going to see that more upside moving forward here. In terms of upside, we're certainly seeing that when it comes to Xpeng shares here today. There you go. We're still punching about 15% for the stock here. A lot of optimism about humanoid robots, Dave.
Yeah, in fact, let me just borrow a phrase from the CICC report, the broadening out of the AI rally into other sectors and the use of key technologies, to result in something like the Xpeng story from their AI day last week, and the market is responding quite nicely. 15% best day, highest level here in about 3.5 years on Xiaopeng. Hang Seng Index, Hang Seng Tech, CSI 300, as we enter the last 30 minutes of the morning session. There, let us see you being a bit of downside across the markets today. It's been topsy-turvy. We've been somewhat of an uptrend, of course. We just showed you that chart earlier on. We are on track still to outperform MSCI China over S&P for the first time since 2017. We'll see you all tomorrow.